I'm Judy Shaw for NYSE Floor Talk. Joining me today is Brandon Rakszawski. He is the Director, ETF Product Development at VanEck. Brandon, it's great to see you. Thanks for joining me.
Thanks, Judy. It's great to be here.
Thank you. Now, quick note to viewers, this interview is for informational purposes only. The NYSE doesn't recommend any investments or investment strategies. Now, Brandon, let's talk about business development companies. What are they?
Well, business development companies were created in 1980 by legislation, actually, in order to increase financing available to smaller private companies. BDCs themselves are actually regulated under the Investment Company Act of 1940. So similar to mutual funds, ETFs, closed-end funds. And BDCs are probably most similar to closed-end funds. And as such, there are restrictions placed on BDC investments, their use of leverage, as well as other investor protections that are afforded under the 40 Act. Now, most investors access BDCs through their publicly traded equity shares. And BDCs, as I implied up front, their portfolios are made up of loans primarily to smaller private companies. If you think of a company that's too small to access the public markets, like the NYSE or other areas or other venues, but just too large to efficiently leverage smaller regional bank financing opportunities. These private middle market companies, that's who is working with BDCs to help fund operations or fund expansion. I think you can think of BDCs as publicly traded access to private credit.
Now, how do these companies generate income?
Well, because these companies are lending to smaller private companies, there's credit risk associated with these loans. Most of these companies and their associated loans, if they were rated, would probably be rated below investment grade. So that credit risk allows BDCs to impose attractive and beneficial terms in terms of the interest rates applicable to these loans and other characteristics. So, these financing terms have driven a very attractive yield for the space that has pushed double digits, if not higher, historically. Add to that the fact that BDCs can receive beneficial tax treatment so long as they distribute substantially all of their net income and capital gains to shareholders each year. So BDCs, in order to qualify for this beneficial tax treatment, essentially pass through the income they generate to their underlying shareholders. So both of those aspects together have resulted in a very attractive income story over the past decade plus.
Okay, now finally, tell me, how can investors gain exposure to BDCs?
Sure. So one way is through VanEck's ETF offering, which we listed at the NYSE in 2013. That's the VanEck Vectors BDC Income ETF, ticker BIZD, or as I call it, BIZD. BIZD offers a diversified basket of BDCs covering the entire BDC market, which is attractive to a lot of investors due to the unique credit risk that each of these individual BDCs carry. So this prevents investors from having to undertake the individual credit analysis necessary to invest in individual BDCs. Investors have increasingly become aware and attracted to that impressive yield story that comes with BIZD, as well as the access it provides to the private credit markets.
Okay, wonderful. Well, it's been great to talk with you, Brandon. Thanks for joining me on NYSE Floor Talk.
My pleasure. Thank you.